Hello, in this presentation we're going to talk about equilibrium. We're going to do that looking at our familiar graph here. We have the price on the vertical axis and the quantity on the horizontal axis. We have our upward sloping supply curve, our downward sloping demand curve, and of course the point of equilibrium is in the middle where they intersect. The idea of equilibrium is that the invisible hand, the market forces, are going to drive us to that equilibrium point, determining what the market price should be. Market price would be in here, and the market quantity. So the market quantity, market price are not being determined by any individual, they're being determined by the market. The market forces are driving us towards equilibrium. Why? Because these suppliers here are competing with each other. They're competing with other suppliers in order to make a profit. In doing so, they're driving down the price in order to be able to sell their goods. And on the consumer side, on the demand side, they're competing with each other in order to purchase the goods that they want to purchase. Means that they're going to compete to drive up the price with each other. Those market forces driving us towards equilibrium. That means that this equilibrium point is generally thought to be the most efficient point, meaning that's the most efficient price and quantity for a particular market. This is a classical model. There are assumptions that are made to end up at that point, such as the idea of perfect information and perfect competition. We'll talk about where we veer off, and there's exceptions from those classical model assumptions, but the classical model is the starting point. This idea of equilibrium and the market price is a very powerful idea that's going to be applicable in a lot of different areas. Let's analyze it a bit further. In order to analyze it, we could say, let's set a price outside of the equilibrium price and see what happens. For example, if this is the equilibrium price here, what happens if we have a price that's out of equilibrium for a period of time? If there's no other factors affecting the market at that point in time, meaning no interference within the market, we would think that we would drive back down to equilibrium. Why? Because at this price, the quantity demanded is going to be here. The quantity supplied is way out here, meaning the suppliers are willing to supply a lot more at that price. And remember, the suppliers aren't just setting the price, they're basically price takers because of perfect competition. Therefore, if they think that this is the market price, they're willing to produce out here. But at that point, it's above equilibrium in reality, and that means that the demand is over here. So what's going to happen? There's a lot more supplied than demanded. We have a surplus. And if there's no interference in the market, you can imagine a lot more pizza being produced, or the capability being produced in this case, and it not being demanded, it not being consumed. And therefore, what's going to end up happening in order to move the inventory is the price is going to have to go down. We're going to have to reduce the price. That's going to be the downward pressure that's going to lead us back towards that equilibrium price, bringing us towards the equilibrium. What if we imagine that the equilibrium price is here, and for the short run, there is a price below the equilibrium price? Well, what would that mean? That means the suppliers are willing to supply this quantity at that lower price. They're not willing to supply as much. And of course, at that low price below equilibrium, the demand is much higher. So now what we have is a shortage. We have the suppliers only producing this much. We've got people knocking down the door, ordering the goods that are being supplied, not enough being supplied at that lower price. All else equal, what's going to happen? Well, the suppliers are going to say, I'm going to increase the price. The only fair way to decide who we should distribute the goods to from a supplier standpoint is to increase the price. And of course, from a supplier standpoint, they're looking for their self-interest. They're trying to maximize profit. That's why they would increase the price. But at the same time, the increase in the price is the only fair way to decide, out of all these people that want the certain good, who should get the certain good. The people that are willing to pay more, that means it's worth more to them, and that's what would end up happening, pushing the price back up to equilibrium. We can also imagine this and say, well, what if we imagine the quantity to be at a different point? So what if we say the quantity and start there and say, now that the quantity is to the left of the equilibrium quantity, what would happen then? Well, that would mean that the suppliers are willing to supply at this low price here for that last unit, and demand is way up here. People for that last unit are willing to pay way up here, and the suppliers are willing to produce it for this price that's way down here. So that there's a huge gain that could be gotten through trade from that transaction. So that would be the case all the way back to the equilibrium point. Therefore, this entire section there would be unexploited gains from trade. If there was perfect communication, if they can talk to each other and negotiate, we're assuming that the market forces will drive us down to the optimal setting where there aren't any unexploited gains, that would be, of course, at the equilibrium point. And we can also assume, well, what if we have the quantity on the right of the equilibrium quantity? What would that mean? That would mean that the demand would be only demanded at this price way down here, this low price, and the supply, if that was the quantity, suppliers for that last unit would have to have a price way up here. So if that was the case, if the quantity was way out there, the suppliers would need to charge a price that's much higher than the demand is, and they wouldn't be able to sell at that higher price. That means the forces are going to drive them back again towards the equilibrium quantity, because the supplier cannot sell the quantity for this price for any extended period of time. They're going to lose money, and they can't charge this price because there's no demand for that price. Market forces pushing us back towards the equilibrium. That means that that entire space there would be waste. That entire triangle would be waste. So we're to the idea then that equilibrium quantity, the market forces pushing us towards equilibrium, will give the optimal price, the optimal equilibrium price, the optimal equilibrium quantity, without any market interference, without any one individual saying this is what the price should be, this is what the quantity should be. You let the market do that. That's the idea of the free market concept. In doing so, we can calculate what the consumer surplus is, which is the amount below the demand curve and above the price. We can calculate what the producer surplus is, which is the amount above the supply curve and below the price. The area of the triangles is, of course, going to be the base times height divided by 2. And if we added both of those up, that would be the gains from trade to the entire market. That's the benefits from trade to the market. It's also important to note that we could look at this in terms of numbers. If we put some numbers together, we've seen some numbers in the prior videos. If we put supply and demand on the same curve in terms of those numbers, we could see it graphically here, where we've got the quantity demanded, quantity supplied, and of course at this point of $100, we've got the quantity demanded equal to the quantity supplied, and that point is here, $100, we've got the quantity demand meeting the quantity supply, giving us a market equilibrium price of that $100 and a market equilibrium quantity of 30 in this case. So we could see this in terms of a table. We could, of course, graph that table, and we will be doing more of that in the future.